Hi, welcome to Down Payment Assistance Programs for Realtors. My name is Jesse Rivera. I am a mortgage broker in the state of California. This is a recorded version of a down payment assistant workshop that I do for Realtors. I do this recorded version because I value your time. I know you Realtors are very busy, and sometimes you just can't make an 11:30 workshop. So I just did this recorded version so that you can watch it at your leisure and go back, watch it again, and get what you need from it. If you have any questions, feel free to reach out to me. You can ask questions down below in the chat, and I will get that via an email and answer them in the chat. Or you can just email me at jesse@jesserivera.com. There's my contact information. I'm a mortgage broker in the state of California. So I'm going to make myself smaller because you don't need to see my big head during the whole presentation. So what are we going to go over today? We're going to go over why I love DPA, some common myths of the down payment assistance programs that I hear from realtors a lot, who is a good fit for it, and pros and cons. That's a big one. Each one of these programs is different. They each have their own pros and cons. There's no perfect DPA program. We know that. But it's a great tool for getting buyers into a home. We're going to look at a case study and my favorite programs. We're going to look at 5 different down payment assistance programs that are available through the whole state of California. And one of them, the plus one, is only available in the city of Los Angeles, but it's a good one. And we're going to look at next steps. If you're interested in working with first-time home buyers with me and doing a down payment assistance program, what comes next? Now, I know a lot of you are just going to jump to the favorite programs, the down payment assistance programs, and that's fine. Go ahead and do that if you want. But I encourage you to look at all of this, and especially the case study, because I'm going to go over what it looks like with real numbers. And all of this is a way for you to sell it to your buyers, right? If you have a buyer who's a good fit for this program, you need to know a little bit about it so you can sell it to the buyers and send it to me. But you don't need to be an expert. I'm going to emphasize this several times. You don't need to be an expert in these programs. That's my job. Your job is to know a little bit about it so that you can talk to your buyers and send them to me, and then I could sell it to them, and I could talk to them. I could figure out what their financial goals are and if this is a good fit for them financially, and then I'll go over the numbers with them, and we'll pick a program that's a good fit for them. So that's my job, to be an expert in these. You don't need to be an expert. That's why I encourage you to look at all of this stuff, because they will have questions, and this is a good start to start answering them. So why I love DPA. Number one, it gets buyers into homes right now instead of waiting to save for down payment. We all know that home prices are going up, and it could take them a couple years to even save for a 3% or 3.5% down payment, 2-3 years. A lot of people aren't that disciplined with their money. So getting into this gets them into a home right now. We all know home prices are going up, interest rates are going up, so buyers just can't catch up. So if they have to wait 3 years, the home prices, who knows what they're going to be in 3 years? They're going to be up. If you think that we're going to have a housing crash, I would think again, because it's supply and demand. I really think housing prices are still going to appreciate. It's not going to be 20% like it was last year. It's going to be a slower progression, 5 to 10% a year. But still, because there's a lot more buyers than sellers, home prices will still be going up. Buyers just can't catch up. So, and we're going to go look at some numbers that will verify that in a little bit. Another reason I love DPA, and you should too, is because buyers will be moving up in the near future. Most of the times that people who use the down payment assistance programs are first-time home buyers, and they don't buy their forever home. They buy a condo, they buy a townhouse, they buy a smaller house, 2-bedroom, 1-bath, because that's what they can afford right now. But in 4 or 5 years, 6 years, as their family grows, as their income grows, they're going to want to move up. So if you keep in touch with them, you will have another couple transactions in 4 to 6 years, right? Because they're going to want to sell, and they're going to want to buy as well. So keep in touch with them, and you'll have some more transactions in the future. The other thing is, if you get to them into a home now, they're going to tell all their friends about you. So it's just a great way to get the word out about you. It's a great way to get more business if you complete a couple of these. Another reason I love DPA is because millennials are the biggest demographic right now. They are overtaking baby boomers, and they're buying, as a demographic, they're buying most of the houses right now. As you can see, millennials are 36%. Young boomers and old boomers together are around 32%. So they're buying most of the houses right now as first-time home buyers, and that's just going to increase as baby boomers start to settle in. They're not buying new houses, right? They might be selling. They might be buying smaller houses, but as a whole, right now, first-time home buyers are the biggest demographic, and you want a piece of that market. So let's look at common myths. I'm going to just go through this really quickly because I want to get to the programs. Myth number one, down payment is only for first-time home buyers. That's not really true. Some of these programs are for first-time home buyers only, but some of them aren't. A few of them you don't need to be a first-time home buyer. And remember, first-time home buyers is defined as someone who has not owned a home in the last 3 years. So even if they owned a home 5 years ago and they're looking to buy a new home, we can use all of the programs for them, for down payment assistance programs, because they are qualified as a first-time home buyer. So another common myth, it's a much more difficult process. Not really. Most of the lenders I work with for the down payment assistance do the down payment assistance in-house. So it really is a seamless process. It might take a couple days more, but we can get these done in 30 days if the appraisal comes in on time. The only one that takes longer is the Los Angeles one because it's a separate program. It's put on top of a regular FHA loan or conventional loan, and it has to go through the City of Los Angeles Housing Authority. So that's an extra 30 days. That's a 60-day process. But it's a great program if you're in Los Angeles, which includes Los Angeles, includes Wilmington, includes San Pedro, and includes Harbor City. Those are all considered the City of Los Angeles, right? Another myth, DPA is only for inexpensive homes. Well, there's a couple of the programs that will let us do high balance. So if you're in a high balance county, and of course it's county by county, right? The maximum loan amount for each county is different. But here, like I'm in Long Beach, so Los Angeles County, Orange County, this year we can go up to 822, 375 in a couple of the programs. And next year, high balance is going up to 937, 500. So it depends on the county and it depends on the program, but we can go higher. Most of the time, this program is used by first-time home buyers, and it's usually a condo in the $250,000 to $500,000 range. So we don't have to worry about this. So most counties can use the DPA and get them into a condo or townhouse or a small house. But if they have the income to get into a higher $800,000 house, we can do it. And the last myth, DPA dollars are never forgiven. Yes and no. Some of them they're not forgiven, but some of them are. Some are grants, so you can refinance out of them, and the grant goes away. One of them, the grant goes away over time, so over 3 years. So a couple of the programs, the DPA amount is forgiven, and a couple not. You have to refi and pay it back. So it depends on the program on that. And the last myth, it's harder to get sellers to accept DPA offers. Yes and no, sometimes. It's a tough market. So if you're up against cash offers, if you're up against 20% down, we have our work cut out for us. But we can mitigate it sometimes. We can do a TBD approval, which means to be determined if you're not familiar with that. I have a few lenders that will do a TBD, which just means we take the file, we get pre-approved with the actual underwriters. So we send the file to the underwriters with the lenders, just like if you've started escrow and it gets sent to the underwriters. They will look at the at the file and approve it. And so we have that approval right away. So when we go in to make an offer, we can tell the listing agent and the seller, hey, we're ready to go. We've been approved. This buyer has been approved. They looked at income. They looked at assets. They looked at credit. They looked at everything, and they're ready to go. All we need to do is get an appraisal and do an inspection, and we're off to the races. So that's a powerful one. And there are other ways, including a call from me to explain it. That's always powerful. So this is a people business. Remember, 100%. When you're working with a listing agent, you need to communicate with them, and I need to communicate with them. They want to work with people they like and trust. And if we can communicate that these buyers are solid, they've been approved, there's a much better chance for us. So who's a good fit for the DPA? Starting off, someone with decent credit. Doesn't have to be perfect, right? We'll see when we get to the programs. We'll see the minimums are 600s, mid 600s. Fine. Some of them you have to be at 680, but that's probably the highest. So just decent credit. We can't be 500. We can't have bankruptcies, stuff like that. Decent credit, we can get them done. Good income. And that's kind of essential because we're going to go over the pros and cons in a minute. But one of the cons is, the DPAs usually have a higher interest rate, and sometimes a much higher interest rate. That's how the lenders pay for these programs, right? Nothing's for free in this world, especially with banks and lenders. So they need a way to pay for this. So their monthly payment for the buyers using DPA will be higher for a year, maybe 2 years, until we can refinance them. And that's the beauty. Like I said, I'm going to go over the pros and cons. But that's one of the beauties of these programs. We can refinance them out of these programs and get them a much, much better interest rate in a year. So they have to have that income to be able to support that payment for at least 12 months. And then we could refinance them and get them a much better rate. They just have not had the chance to save for down payment. And there's two scenarios for this. One is they're just starting their career. They're out of college, 1 or 2 years. Good jobs, good incomes, but they haven't had the time to save for that down payment yet, and they don't want to miss the housing market. They're financially savvy, and they know getting a home is the road to financial security, right? So that's the first one. The other scenario is some people just spend as much as they make, right? So they really don't have the financial discipline to save for down payment, or they do, but it'll just take them forever, and that's okay, right? We need to serve these people too, because a home can, that payment can be a forced savings account for them. As their home appreciates, right? So will their wealth, so will their financial security. Where I come from, where I live, there's a lot of millionaires, but most of these millionaires hold their wealth in the home, in their equity. They bought a home 30 years ago, paid it off, are still paying it off, and the home went up in value. So we can't look down on these people who don't have that utter discipline to save, because we can help them too. We can help them with their financial security and helping them use their home to build wealth. Single or married that make good money but live paycheck to paycheck, we talked about them, right? And the only way they build wealth is through their home. We shouldn't look down at these people because we can help them build wealth. But I think I got ahead of myself and talked about these already. So who is not a good fit for DPA? Someone who's marginal income, someone who just does not make enough to support the DPA payment for a year or two. And that's an important distinction, because they will have to make that higher payment, and some people just can't. Bad credit. There are some credit minimums, FICO score minimums. If they're so bad we can't get it done, we'll send them to credit repair. And when they're ready to go, we'll get them started, and I'll contact you. And people who have unstable income, that goes with marginal income as well. But that goes with people who are a good fit as well. We need a good history of employment. So let's look at pros and cons. Okay, we're going to start with the cons. We're going to start with We're going to start with the bad news. Higher interest rate. We talked about that a little bit. Nothing comes for free. So these banks need to make money. They need to be profitable to make these programs work, or they just won't do them, right? Because a higher payment equals higher income requirements. And some of these programs have lower DTI, debt to income requirements as well. So that's a double whammy. Not only they need more money to make the higher payment, but they need more money to qualify as well because of DTI requirements. Not all of the programs, but some of them do. Some programs have income restrictions. Not all. A couple of the programs don't have income restrictions. A couple of the programs that do have very generous income restrictions, and a couple of programs have very stringent income restrictions. Some require that you be a first-time home buyer. Not all of them. Some you don't need to. Higher loan-to-value at closing. Okay, so that's one of the disadvantages, right? If you use DPA, if you use an FHA loan, the first loan is going to be 96.5%. The second loan is going to be 3.5%, and plus you add the mortgage insurance, which is 1.75%. So you're underwater right off the bat. So that is a big con, but I don't think it's in this market. As homes appreciate, I think they'll get above water very quickly. So it's up to the buyer. If they're not comfortable with that, fantastic. We'll figure out a way to get them to save for down payment and contact them in the future. And if you borrow closing costs, it just gets worse, right? Some of these programs allow you to borrow closing costs. So if you're at 101.75 and borrow 2%, 3% for closing costs, yikes, you are underwater. All right, let's look at the pros now. Let's get some good news for a second. So what are the pros? Money for down payment, of course. You get to buy now. Some of them you don't have to pay back. Some of them are grants. So if we refi in a year, that 3.5% grant will go away. That's fantastic. That's great. One of them will even let you borrow closing costs and the 3.5%, and it goes away when you refinance. That's amazing. But like I said, every one of these programs has pros and cons, and we'll talk about that in a minute. It allows you to buy sooner, right? That's a big one in this market. Most people don't want to miss the boat. They want to, because homes are going to keep appreciating. Some more pros. You can get money for closing costs if you need it. Ideally, we should shy away from that. We should try and get closing costs. If they have no money, then we could do seller closing costs, right? We can get gifts from family members. I could get a lender credit to help them out. So we could do any of those or all of those or a combination of all of those. The less money they have to borrow, it's much better, right? They'll be underwater for less time. And you can refinance in a year and get a much better interest rate. So most of these programs have a higher interest rate. Some have a pretty high interest rate. Some of them have just an okay interest rate, a decent jump. But all of these programs, and I'm trying to think if there's an exception, and when I go over the programs, I'll let you know. But you can refinance in a year, and either if it's a grant, the grant goes away, and you get a much lower interest rate. If it's a second mortgage on there, you can refinance out of that second mortgage, but it doesn't go away. But you can still get a much lower interest rate. And I'm going to go over the numbers in a second. So, like I said, you can refinance a year, get a much better interest rate, and get rid of the down payment assistance. Okay, so let's look at a case study. Let's look at a purchase price of $500,000. We're going to see what the numbers look like. 3.5% down payment. This is an FHA loan. 3.5% down payment at $17,500. So we're going to get a down payment assistance for $17,500. It's going to be a silent second. We're going to go with a little worst case scenario. It's not a grant, so it's not going to go away. When we refinance the silent second, it's going to be added to the refinance. So it's a silent second of $17,500. The silent part of the silent second just means they don't have to make payments on it during the duration of the loan. It will have an interest rate and it will accrue, but they only have to make payments on the first mortgage and not the second mortgage. So that's what a silent second is. So the first mortgage is going to be $482,000 at 5%. Like I said, the interest rate will be anywhere from 3.5%. Some of them are 6.5%. If you're going to borrow closing costs, but but remember, when we refi, we'll get rid of that higher payment. They just have to make that payment for a year, usually, to be able to, and then we could refinance, get out of that. So I'm going to do kind of a middle ground on the high side, 5%. So their mortgage payment is $2,590. That's mortgage payment only, principal and interest only. I'm not going to put in mortgage insurance. Taxes and insurance, of course, those will be in their mortgage payments, so it'll be higher. But I just want to do an apples-to-apple comparison to see what the savings are when they refinance, and see if this program is even worth it. Okay, so their mortgage payment is $2,590. So they refinance in 12 months at 2.5% down payment. Right now, I can do even better than that. So maybe in a year from now, it'll be 2.5%. It might be a little higher. So their new mortgage payment will be $1,975. This is a monthly savings of $615. So if they can make that higher mortgage payment for a year, they'll get a great interest rate. They'll have a home that's appreciating. So let's look at it. So is it actually financially a good idea? Let's run some numbers. So 12 months, they're paying that high interest rate. That's $73.80. So that's how much more they'll pay for that year because of that higher interest rate. So let's do a reasonable appreciation of their home. It's probably going to be more than that, but let's do a reasonable appreciation of $500,000, 5%. So their home goes up in value $25,000. So $25,000 minus $73.80. So they're ahead $17,620. So that's, this is a selling point. This is how I'm going to sell it. This is how you can sell it as well. That, yeah, you're going to make a higher interest rate. Yeah, we get it. But once we refi, you're going to be up ahead. You might be even way ahead. So what happens if they want to wait? So if they tell you, well, I'd rather wait. I don't want to go through that. I don't want that higher payment. Well, let's see what happens if you wait to save. Let's say you save $1,000 for 2 years. If they can do that, not a lot of young professionals can do that. 5% appreciation. Now the price of the home, that $500,000 home in 2 years is now worth $551,000. Okay, that could have been their appreciation. They could have been up $51,000. But okay, so they wait 2 years. It's going to be a higher interest rate for an FHA loan. It might be 3%. So their loan amount's $531,957. So their mortgage payment is going to be $2102 if they wait to save for 2 years. Okay, so let's compare the two. If they wait or if they use the DPA now. So using DPA, their interest rate right now is 2.5%. If they wait to buy, it's going to be more. I guarantee interest rates are going up. So it's going to be 3%. The monthly payment is $1,975 if they use the DPA and refinance out of it in 2 years. If they wait, their interest rates, their payments can be $2,102. It's not a big difference, like $127. Okay, not a big difference. So, but here's the big difference: equity. Homes are still going to go up in value, even 5%. So their equity, if they use the DPA now, as opposed to buying in 2 years, the equity is going to be $67,500, and that includes paying down the mortgage a bit, right? So it includes appreciation and mortgage pay down. If they wait to buy, their equity is going to be $19,293, which is just their down payment. That's their equity. There's their down payment. So is it worth it to wait? Yes. We show them the numbers. We show them the concrete numbers. Now, the only reason they wouldn't go forward with this if they think there's going to be a housing crash. And we all know, I firmly believe that there won't be. I firmly believe that home prices, at least for the next 5 years, are going to go up. So The only reason they wouldn't think this is a good idea if home prices aren't going to go up. So that's up to them. Okay, we're getting close to looking at down payment programs, but I want to just share a couple things with you. There's no perfect loan. There's no perfect down payment assistance program. Each one has their own pros and cons. All right, we're going to see that. They're always changing, right? So as of today, this is the information I have as of today. A month from now, 6 months from now, could be completely different. I'll require homeowner counseling. Costs anywhere from $150 to $250. At least one of the buyers has to go through homeowner counseling. And you don't have to be an expert on these, right? That's my job. That's why I'm here. You just have to know about these programs, be able to sell them a little bit, and then send them to me. So we're going to go over 5 programs that are available in the whole state of California. And actually, we're just going to go over one in the city of Los Angeles. I just didn't have time to change this. So CalHFA, CalHFA, I think this is the most popular one. You probably all know about this one. It's a good program, not one of my favorites. We'll start with this one because it's the most widely known one. And these are the things I'm going to go over with each of these programs. So the loan type is FHA or conventional. You can do either. Is it a loan or a grant? It's a loan and a silent second. Remember, silent second means they don't have to make payments on that second mortgage. It will just accrue interest over time. Repayment terms, it's not forgiven. It has to be repaid at sale or refinance. The loan amount is a non-balanced limit in your county. In my county, it's $548,250. Actually, it's going up to $625 next year. But I actually have lenders who are lending at $625 right now. But right now it's $548, and it's county specific, right? Your county will be different. There's only a few counties that are $548, so you have to look at your county conforming limit. The DPA amount, you can do $15,000 or 3.5%, whichever is less. But with CalHFA, if you're a school employee or a firefighter, you're exempt from the DPA amount. So if you need to borrow $20,000, they'll let you if you're a firefighter or a school employee. I don't know why they picked those two. Income limits, yes, there are income limits, but they're pretty generous. They're on the high side. They're in like the low $100,000 for a family of 2. So that's fine. First-time home buyer, yes, you have to be a first-time home buyer. Minimum FICO score is 660. Debt to income is max is 45%, so it's a lower debt to income. So this is one of the reasons people who are a good fit make more money. And property types: single family homes and approved condos, FHA approved condos. And there's no minimum borrow contribution at all. So note, school employees, firefighters are exempt. You can actually get a third loan with CalHFA for 2.5% or 3.5% for closing costs. So you'll have a primary loan, an FHA loan. You have a down payment assistance loan, and if you get a loan for closing costs, you have a third loan for closing costs on top of that. Loan limits are going up to $625. So CalHFA, it's a good middle of the road program. Not my favorite. We're going to look over some more that I like better. DPA Advantage. It's with one of my lenders, AFR. I like this one. This one has some great pros, some great advantages. Loan type is FHA. This one's a grant. That's one of the reasons I love this one. It is a grant, and you can refinance it and eliminate the grant after 1 year. So this is a fantastic program. This is why I love this one. It only goes to non-high balance limit, which is 548 in my state, going up to 625 next year. It's county specific. Remember, your county might be different. DPA amount, you can do 2% or 3.5%, depending on which one you need. You can also get a lender credit for 3%. So that's nice for closing costs. So you can get a 3.5% down payment assistance, and then they will allow us to do 3% lender credit to pay for closing costs. So fantastic if you have buyers who don't have a lot of money or don't want to spend a lot of money. they can essentially get in a home with almost no money. The disadvantage of that, it'll bump up the interest rate to like 6.5%, even more. So, but if they can make that payment for 1 year, if they can make that 6.5%, interest rate mortgage payment for 1 year, we can refinance, get rid of the lender credit, get rid of the 3.5% down payment assistance program, and get a smoking interest rate if it's FHA or conventional. So that's why I like this program. If you can afford it for a year, thumbs up. No income limits, no first-time home buyers, minimum FICO 620, which is really good. DTI maximum goes up to 48.99%, which is decent. Single-family manufactured homes, approved condos, and you could get a duplex. You can buy a duplex, rent out the other side. It'll help you. That income we could use for the second unit. We can use that to help qualify for the loan. Fantastic. This is fantastic. I like this program. No minimum contribution. It's not a first-time home buyer, but there are lots of ways. There are specific ways you can qualify. So you can be a first responder, right? That's a police officer, firefighter, public safety, paramedic, emergency, EMT, something like that. You can be an educator. You can be admin at a school. You can be a tutor. You can be a daycare provider. And listen to this. You can be a volunteer at your kid's school for 1 day a month. We just need a letter from the teacher saying that you volunteer and you qualify for this loan. Medical personnel, all medical personnel, including American Red Cross. I'm reading this from my side screen. Civil servant, federal, state, or local municipality, and of course military, active, or veteran, retired. So there are some limitations, but the limitations are they're so small that almost anybody can get this loan. All you have to do is volunteer at your school. Okay. Golden State Financing Authority, GSFA, good for the whole state of California. This is an FHA loan. This program is okay. It's good. It's not fantastic. I like the DPA advantage better because it's a grant. This one is a loan. It's a silent second. We know what that means. This one, repayment terms, it's forgiven in 3 years. Actually, it's 1/3 of it's forgiven every year, but actually 1/36 is forgiven every month. So every month that you have a loan, 1/36 of the loan is forgiven. So if you hold it for 3 years, that silent second goes away. So that's nice. If you can, and the interest rate does not go up a whole lot from a regular. So if you can hold this loan for 3 years, the DPA goes away. That's nice. So I mean that's a middle ground. I mean this is a middle ground where over here we have DPA advantage, and when you refinance it all goes away. It's a grant. And down over here you have it's just a loan, and when you refinance you have to repay that loan. In the middle the DPA goes away slowly, and once you refinance, if you refinance in 3 years, you get a better interest rate, and you don't have to refinance that 3%, that 3.5%. If you refi in a year and a half, half of it goes away. So it's a decent loan. Conforming limit only, no high balance. You can borrow 3%, 4%, or 5%. Income limits, no income limits. First time home buyer, minimum FICO 660, 680 if you're manufactured. DTI is lower. It's only 45%, so you need to make more money. Property types, 1 and 2 unit. You can get a duplex with this one as well. Manufactured, approved condo, single family, no minimum borrower contribution, so the borrower does not have to bring anything if they don't have it. Loan limits going up to 625. Oh, I forgot about this. This is an advantage of this one. So if you're a first responder, an educator, I don't think if you volunteer at the school, but an educator or work at a school. If you're in the medical field, if you're a civil servant, or if you're in the military, the DPA is a gift. So I forgot about that. So the loan, it doesn't become a loan, it's a gift. So if you refi in a year, that whole DPA goes away if you're in one of those eligible fields. Okay, that's great. So I forgot about this one. It just went up in my book. So Chinoa's been around for a while. Every one of these has pros and cons. This one's okay, and there's one reason I like this one. It's an FHA loan, second mortgage loan. You do have to make payments on the second mortgage. It's not a silent second, so you're making payments on the first mortgage and the second mortgage. Forgiven if refinanced, depends on the program. So let me look at my notes down here. So in 36 months, if you borrow 3.5%, it's forgiven in 36 months. If you borrow 5%, it's forgiven in 60 months. Okay, so forgiven if refinanced, but it depends on the program. If you borrow 3.5% and refi in 24 months, you have to pay the whole thing back. There's no, it doesn't get forgiven over time like the HFSA. Minimum FICO 640. DTI max 45, that one's a little bit lower, right? Single family, 1 to 2 units. This one you can borrow for a duplex as well, approved condos. Oh, I forgot up here, DPA amount 3.5% or 5%, depends. No minimum borrow contribution, but what I like about this one, you can go high balance. So if you're in a high balance area like Orange County, San Diego County, LA County like me, and if you want to buy a $700,000 home, this one can do it if you can qualify, right? So that's what I like about this one. That's why this is included. If you have a buyer who makes great money, has good credit, they just for whatever reason have not been able to save for down payment, this is it. This is the one. Okay, that's everything on this one. So the NADA loan, nada, nothing. That's funny. They try to be funny. This is with one of my lenders, and this one's FHA. This is a middle of the road program. I like it for one reason. Second mortgage loan, you will make a payment on that loan. It's refinance after 1 year, not forgiven. So you can refinance in a year, but you have to pay off that second mortgage as well. Conforming in a high balance, like it. This is a high balance one. So this is great if you have buyers in that high balance range, over 625 loan amount. DPA 3.5%. That'll cover the FHA down payment. No income limits. No first-time home buyers. Lower credit score 580. DTI max. So we can go all the way up to 55% debt to income ratio on this one. And if you didn't know this, regular FHA, I can go up to 55%. In fact, I think I can go up to 56.9. I think I've done 56 in the past. One reason I really like this one is you can buy a 4-unit. You can buy 1 to 4 units. So if you're in you can't do that where I live. You can't buy a 4-unit for under $900,000. That's ridiculous. But if you're in a county where you can buy a 2, 3, or 4 unit, for under $500,000, $400,000, whatever your conforming limit is, this is the one for you. Single family, manufactured, approved condos, and no minimum contribution, right? Max loan amount depends on your county, for sure, 100%. Okay, last one. We're almost done. I tried to keep it an hour. I think I might do it. City of Los Angeles, moderate income. Remember, City of Los Angeles means San Pedro. So if you work San Pedro, it means Wilmington, and it also means Harbor City and the whole city of Los Angeles. So this is a very interesting one. I think it's great. And I'm gonna have to explain a little bit more because it's different than the rest. So that you can do conventional or FHA. And with this program, it's separate. It's on top of a regular loan, so they don't bump up the interest rate. So I can do a loan right now with this down payment assistance program. I can do an FHA loan for 2.5% down payment 2.5% interest rate right now today for this down payment assistance program, and then the City of Los Angeles puts their DPA on top of that. So it's a separate program. Remember, it takes longer. It takes 60 days because for that DPA, they has to get approved by the City of Los Angeles, and there's an inspection and everything. So it's a silent second, so you don't have to pay on that DPA part. which is nice. It's a mortgage loan. It's not a grant, so it stays there. It's not forgiven. It's repaid at refinance, repaid at sale or refinance, but you don't have to make payments on it. There's no max loan amount for this one. So in the city of Los Angeles, but we have to go with FHA. So it's county loan limits pretty much. So I should change that. So technically with the city of with this program, there's no max loan amount. You can get a jumbo if you wanted to. And I think they wouldn't care. I've never done a jumbo with them. But it's usually county limits, whatever your county limits is, and they can do a high balance. So the DPA amounts, you can get $35K or $60K amount, depends on your income, right? The more money you make, the less you can borrow. So if you make less money, you can make $60K. If you make more money, you can get $35K. And that goes straight towards down payment. It goes straight toward closing costs. So you don't need a penny. You might need earnest money, but you don't need a penny. You can borrow 35 or 60K. And the income limits are generous, so it's not bad. So I wouldn't worry about that, and I'm not going to talk about that right now. But if you're interested in this one, contact me. We'll talk more about it. I might do a separate video on this because there's more moving parts. Income limits, yes. There are income limits, and that's for the DPA amount. But like I said, they're not horrible. First-time home buyer, yes. You have to be a first-time home buyer with this one. You cannot have owned a home in the last 3 years. That's what a first-time home buyer is. Minimum FICO, whatever the FHA standards are, whatever we can do for FHA. So remember, they don't really care what the loan underneath looks like as long as you can get that loan. They put the DPA on top. DTA max there is known. That's whatever the program is. Property types, single family, townhouse, condos, right? First time home buyers, first home, they're going to get a first home, townhouse, condo, small house. Minimum borrower contribution, yes. The borrower has to come in with 1%. So I take back that with that 35K that they could get a home for nothing. They have to come in with 1% of the purchase price. So if they're buying a $500,000 condo in the city of Los Angeles, they have to come in with $5,000, and then that $35,000 or $60K will pay for the rest, even towards equity. So how do they pay for this program? So there's a shared appreciation. So when you refinance or when you sell, they're going to take part of that appreciation, and it's just a factor of how much you borrowed from them versus how much the purchase price is. And I'm going to do an example in a second so you see what it looks like. It's not horrible. It's not horrible. Don't worry about it. So plus it's shared appreciation when you refinance or sell a home. They're owed money, that of a percentage of the appreciation. That's how they get paid. There's an inspection needed by the city to make sure it's in good condition, habitable. It's a 60-day escrow because of that, because it has to go through a couple tiers of approval. Remember, San Pedro, Wilmington, Harbor City. That's all Los Angeles, right? Okay, so let's look at a quick example, and I'm done. It's a LA case study of the $500,000 purchase price. Let's say you borrowed $50,000. Okay, so that means, and I'm trying to keep the numbers simple. So that means it's 10%. You borrowed 10% of the purchase price for the DPA. So that means when you sell, you're going to get 10%. The city of Los Angeles is owed 10% shared appreciation. So whatever the depreciation is, if it's $100,000, if it's a $200,000 net appreciation, they're going to take 10% of that. So let's look a little deeper. So let's say you sell it in a few years, 5 years, I don't know, 3 years, 10 years, and you sell for $675. So your appreciation is $175. Okay, so because you bought it at $500, you're selling at $675. The difference is $175. That's your appreciation. But the city of Los Angeles lets you subtract closing costs, which includes your seller closing costs and all commissions, realtor commissions, right? So let's say closing costs are like 5%. So at a $675, which is $41,000. So 175 minus 41,000 is 134. So that's your net appreciation, right? So the city of Los Angeles is going to take 10% of that, 13,400, so that you keep 120,600. So it's not bad. It's not bad. It just depends on how much you borrow versus what the purchase price is. They let you subtract closing costs and commissions from your appreciation to get net appreciation, then they take 10%. It's not horrible. So that's it. I like that program. So do you want to work with first-time home buyers? So I have a first-time home buyer workshop for borrowers, for buyers, for the public. I'm going to start doing them monthly, and I'll have an on-demand version as well, so they can watch at their approval. So you can start sending your buyers to the webinar, right? And I'm going to have a personalized link for you so that I can tell who's sending these people to my webinar, to the workshop, so that I know who they're. So if they decide to move forward, if they call me and we say, yeah, let's get this done, let's get an approval, I know who to call and say, hey, we got John and Nancy Smith approved. You sent them to me. Here they are back, and here's an approval letter. Here's what they can buy. Start looking. So if you want to send your buyers to me, that's fantastic. Just let me know so I can create a personalized link for you, and then you could send that out to your buyers. I will pre-approve and send them back to you, or put them on a roadmap if they're not ready. If you send me these people and they contact me and we talk and they're just not ready, I'm going to put them on a roadmap, whether it's credit, whether it's they need to save some money, whether they have to pay down some debt, whatever it is. I'll put them on a roadmap, and I'll keep in touch with them. And when they're ready, and we can get them pre-approved, then I'll send them back to you. And I'm going to market this program heavily. I'm going to start making some Facebook ads and YouTube ads and start marketing this. And so realtors I work with, if I get people into the program and get a pre-approval and they're not working with a realtor, the realtors that I have a relationship with, I'm going to send it to them for that county, for that city. So are you ready to move to your business to the next level? So a little bit about me. I've been a real estate agent for 15 years. I only do mortgages now for the last 3 years. Because I like it better. I'm a numbers guy. But I owned a brokerage. I trained agents. I hired agents. I mentored agents. And I talked to a lot of agents. I talked to very successful agents. And some of my agents are knocking it out of the park. And we talk and we figure out what the strategies is. And so successful agents have a lot of things in common. They have a written business plan, right? They have a database and they stay connected with past clients. They have a marketing budget, or if you're new, they're willing to work hard. So if you're ready to move your business to the next level, let's have a chat. Let's see if we're a good fit. Let's see if we want to partner up and grow our businesses together. I'm ready to move to the next level in my business. Are you ready? Let's have a chat. Let's see if it's worth it. Make sure you're getting my newsletter. You should be getting it. If you're watching this webinar and signed up, you'll get it automatically. If you don't want to get it, just unsubscribe. I don't want to spam you every week or every couple of weeks when I send these out. But I let you know about upcoming workshops and things that are working and how to get your offers accepted and business planning workshops. And there's a lot of great info in there. Things that are working, things that are working for me, things that are working for the realtors I work with. And so make sure you're getting that newsletter. And if not, let me know. That's it. That's the program. I threw a lot at you. This is a great program, down payment assistance program, a great way to build your business, get to the next level. If you have any questions, feel free to reach out to me. You can put the questions in the chat below, in the comments below, and I'll answer them there. Or you can just send me an email, jesse@jesserivera.com, or text me or call me at 562-576-6885, and let's see if we can get some business together. Thanks for showing up. Thanks for watching. Feel free to watch this over and over again, and let's give me a call if you have any questions. Have a good day.